You're listening to The Voluntary Life, where you can hear ideas for finding freedom in an unfree world. Visit thevoluntarylife.com to connect with the show and hear all past episodes. Here's your host, Jake.
Hi, it's Jake here. Welcome to The Voluntary Life. This week's episode is about investing, and we're going to be talking about investing in gold. Is gold still relevant as an investment, or have cryptocurrencies made it obsolete? And how do you even go about investing in gold? And indeed, why would you want to invest in gold? I'll be addressing these questions and many other great questions that I received from listeners of The Voluntary Life in this episode. And I got those questions from the Voluntary Life Facebook group. If you would like to join that private Facebook community, you can do so by becoming a patron of The Voluntary Life on Patreon. And if you do support the show, then you will receive bonus episodes and many other awards. So if you're interested in that, you can find out more on my website, thevoluntarylife.com, and also by going to my Patreon page, which is at patreon.com/thevoluntarylife. I'll also put a link to that in the show notes. So on to today's show, and we're talking about investing in gold. I'm going to explain my own background in investing in gold. As I've mentioned before, I follow the permanent portfolio strategy of investing, which was developed by Harry Browne and outlined in his book, Fail-Safe Investing. And that strategy involves holding gold as one of 4 different asset classes that are designed to cover you in different economic circumstances so that your portfolio can weather any economic storm. So when I'm talking to you in this episode, I'm going to be telling you about my experience investing in gold, the things that I've learned, especially from Harry Browne's permanent portfolio approach, and I'm just going to be giving you my own approach. I'm not a financial advisor. You have responsibility for your money, not me, and it's up to you what you do with it. So this is just for your information. I'm just telling you my opinions and my own experience. I hope that's helpful to you, but as always, you have to do your own research. So having said all of that, let me tell you a bit more about owning gold. So when Harry Browne designed the permanent portfolio, he looked at different economic conditions and looked at different asset classes that would perform well in these different economic conditions. And one of the economic conditions that he looked at was inflation. What do you do as an investor if there is massive inflation? Like, for example, the inflation that happened in the US and the UK and much of the Western world in the 1970s. When that happened, the value of savings was seriously eroded by massive inflation. And even if you owned stocks during that period, the stocks barely kept up with the inflation that was taking place. And in those types of circumstances, there are certain assets that tend to do really well. And precious metals overall, but especially gold, has historically been the best asset to own in times of huge inflation. That doesn't mean to say that that's going to be the case going forward, and we're going to have an interesting discussion about cryptocurrencies in a minute. But just to explain the rationale behind owning gold, the reason that Harry Browne chose gold as a hedge against inflation is that it has performed best in previous historical examples of high inflation. Now, why is this the case? So if you want to understand a bit more about inflation, I have done a previous episode on inflation. I'll put a link to that in the show notes. But in short, inflation is not just an overall rise in prices. That's what a lot of people think about when they think of inflation. But if you think about it a little bit more deeply, what inflation really is an increase in the money supply. It's an increase in the amount of dollars or pounds chasing the same amount of goods. So if you have a huge increase in the amount of money, then the prices of everything will go up because there's simply more paper money chasing after the same amount of goods. That's a very crude and simplified way of explaining this, but if you want more detail, I'll put a link to the previous episode I've done on inflation, and I also recommend a book called What Has Government Done to Our Money by Murray Rothbard, which is a very good explanation of how inflation works and why gold is a very good hedge against inflation. Gold isn't just a hedge against inflation, it's also, in general, a hedge against uncertainty. In very uncertain economic times, gold can often be the asset that does best. And when you have uncertain times and things are volatile, Harry Brown's idea behind owning gold was that this is the one asset in his strategy of a diversified portfolio. This is the one asset that is really a physical, tangible thing for you to own. Unlike all your paper assets, gold is actually a physical asset that you can own, and that has its own advantages, particularly in turbulent times. In a sense, that is still an advantage of gold over cryptocurrencies, that it is something physical, real, tangible that you can hold and own. And it's also an asset that you can put outside your country of origin as a hedge against turbulent times and massive upheaval in your own country. If there's war or revolution or any other terrible event that could happen, and indeed has happened many times even within recent generations in Europe, then having some of your assets outside your own country of origin can also be a help. This, of course, is something that these days is much easier to do with cryptocurrencies, but you can still do that with gold, and that was one of the rationales that Harry Brown had for owning gold in your portfolio. So the value that comes from owning gold is its capital value. It doesn't produce any interest. It doesn't give you any income owning gold. It just sits there. And that actually brings us to one of the questions that I received from listeners about owning gold is, why would you buy a non-productive asset? Why would you buy an asset that doesn't give you a cash flow? And the answer is you buy it for the potential of capital gain. So in other words, if you own gold and you buy it in made-up units, let's just say that the price of gold is 100 today. If some years down the line that value goes up from 100 to 200, then your investment has increased in capital value, even though in the intervening period you didn't get any interest from it. You can sell some of your gold for a higher price than you bought it for, and you can make some capital gain in doing so. So that's the reason to own gold. And it can be very useful to have assets that only increase in capital value, because you're not paying any tax on the capital gain until you actually sell your asset. So that's the value of gold, is the capital gain. But how do you actually own gold? How do you go about owning gold as an investment? Well, there are various ways to do it. The simplest and easiest way to do it, which I don't think is the best way, but is very simple and easy, is you can simply buy shares of a gold exchange-traded fund. And there are many investment funds that invest in gold, purely in gold, and you can just buy into that fund. And in doing so, you sort of own gold because you own a gold ETF, and the value of that ETF will rise and fall with the value of gold. However, when you do that, you're sort of one step removed from the gold itself, because it's not you that owns it, it's the ETF. So you can also own your own physical gold. You can literally walk into a gold store and buy some gold coins, or you could even buy bullion if you wanted to do that. Of course, if you do that, then you have to work out where you're going to put this gold, and that has its own challenges and its own questions. So the other way of owning gold is to buy gold through a bank and store it in a bank vault. And that's the way that Harry Brown suggested that you buy gold. His thoughts were that, the best way to hold gold is actually to hold it outside your country of origin, so that it's something that you can go to if there's ever some catastrophic event in your own country. Some of your assets are held abroad. He suggested that you simply go to a bank that does store gold for you, and you can buy it through them, and they will store it in their vault, and that's your gold. There are also online gold storage options that allow you to own the gold in a little bit more direct way than a gold ETF, but they're still online. You don't actually have to physically show up to a bank. One of these, for example, is called bullion vaults. There's another one called gold money, and there's various other things out there. And this can be an easy way of owning some gold. And you do own that physical asset in their ledger, but you do it online, and it's kind of simpler and easier than going to a bank, especially if you want to own gold that's held abroad. For example, Bullion Vault allows you to own gold in a vault in Switzerland. Even if you're based in the US, you can store your vault outside your country of origin. So that's another way that you can do it. It's a little bit more direct than owning gold in an ETF. And when thinking about these different options, there is this question of counterparty risk. And that's the risk that if somebody else is holding your gold for you, can you trust them? And I did get a question about this from one of my listeners. The question was about custodial issues of third parties owning gold. And I've kind of gone through these different options that are there for you. And one of the big differences between these different options is this custodial issue. So, for example, if you just buy shares in a gold ETF, you don't know exactly how that ETF is managing their own gold that they own. And you're a little bit more distant from the gold than, for example, if you just rock up to a gold seller and buy some gold coins. So there are big differences between owning the gold physically yourself and having someone else own it for you like a bank, and even more distant, having something like a gold ETF own the gold, where you don't actually own gold, you just own shares in the ETF. So these are some important differences that you have to consider when buying gold. It's a question of balancing risk against convenience. I can tell you that for myself, I've done something very similar to what Harry Browne suggested. Most of my gold is stored with banks outside my country of origin, and it's in a bank vault. And the gold is assigned specifically to me. It's not part of a gold pool. It's gold that I specifically own, and it's held within a bank. But I also use a service called Bullion Vault for a small amount of gold, just because it is convenient and easy to buy and sell and rebalance my portfolio using Bullion Vault. And it's a lot easier to do that rather than accessing gold that is stored in a bank in a foreign country. So that's the balance that I've chosen in terms of convenience versus counterparty risk. You will have to decide for yourself what the most convenient thing to do is. I personally think it makes sense to use a service like Bullion Vault for small amounts of gold. And if you want to get into bigger amounts of gold investing, then I think it makes sense to consider something like what Harry Browne suggested, which is owning gold in a bank vault. I'm not 100% compliant with Harry Browne's recommendations. For example, he recommended that the best thing to own is gold coins, standardized gold coins that are very easy to trade and sell, rather than gold bullion. Just for various reasons to do with cost and ease and everything else, I actually do own gold bullion. I mean, for example, if you use something like Bullion Vault, you're not going to be investing in coins, you're going to be buying gold bullion. That's something to consider for yourself too, in terms of what you actually invest in when you buy gold. For Americans, it can be difficult to follow Harry Browne's recommendation in the permanent portfolio about owning gold outside your country of origin, because a lot of foreign banks don't want to deal with American citizens because of all of the compliance laws that the American government forces banks to go through when dealing with American customers. And I know it can get really complicated. I think Bullion Vault is available as an online service in the US as well. So you could use Bullion Vault for smaller amounts of gold. But if you wanted to get into owning larger amounts of gold and you were very interested in following Harry Browne's ideas, then I recommend you read the book About the Permanent Portfolio by Craig Rowland. I've interviewed him on a previous episode of The Voluntary Life, and I'll put a link to that again in the show notes. But in that book, he has some detailed recommendations about how to buy gold. And in fact, for anyone who's interested in owning gold, that book has a lot of more specific recommendations about the sort of technical side of owning gold. So if you're interested in more specific technical questions, that book is a good place to start. So now I want to tackle an important question for investors considering owning gold, and that is the comparison with cryptocurrencies. This is something I also got asked about by listeners. So in the beginning of this podcast, I talked about the reasons to own gold, and I explained that historically in the past, when there's been serious inflation or serious economic uncertainty, gold has been the asset that has done really well. But as they say in the investing world, past performance is not a reliable predictor of future performance, and it may be the case that in future other assets could perform better in such circumstances. In particular, cryptocurrencies could take the place of gold as a hedge against inflation and uncertainty. And in fact, if you look at recent examples of massive inflation and economic uncertainty, in particular places like Venezuela today and Argentina in the last few years, it's been cryptocurrencies that have really played the role that gold historically has played. So people who are desperate to get around the capital controls and to overcome the hyperinflation in places like Venezuela, what they're doing is they're not buying gold, they're buying cryptocurrencies because it's just so much easier to trade cryptocurrencies than it is to trade physical gold. In a way, cryptocurrencies are like digital gold. And so I think it's very important to consider the question of whether or not gold as an investment is going to be overtaken by cryptocurrencies and whether cryptocurrencies are going to take the place of gold. I have talked to many investors and looked at many presentations by other investors who are interested in hedging against inflation and who have an interest in gold and cryptocurrency. And I would like to suggest to you that there are three sort of camps, three different viewpoints about this. There's one viewpoint from some gold investors, which is that cryptocurrencies are a joke, that cryptocurrencies are just a crazy bubble and that they will never take the place of gold for various reasons. And this camp is pretty much dismissive of cryptocurrencies. There's another camp, which is that cryptocurrencies are so much better than gold that gold is effectively obsolete and you'd be crazy to invest in gold now. You should just invest in cryptocurrencies. And there's a third view, and this third view is the view that I take, which is that cryptocurrencies do have more promise than gold for the future, but it still makes sense to own gold today, and it probably will still make sense to own some gold in future. So that's my view. And just to explain that view, I think that cryptocurrencies are still so new and so volatile that the reasons that Harry Browne had for investing in gold are still valid. The value of all the gold in the world is still massively more than the total value of cryptocurrencies, or indeed the individual value of any specific cryptocurrencies like Bitcoin. No individual cryptocurrency has taken that place yet. And if any cryptocurrency were to take the place of gold as the world's hedge against the dollar, then that would be such a huge upset that even if you only owned a tiny amount of cryptocurrency today, you probably would still be hedged against that eventuality happening. So if you're worried about gold becoming obsolete, then I think by owning a very small amount of cryptocurrency, you have effectively hedged against that happening, because it's going to be such a huge shift if and when that happens that you'll be fine even if you only own a very small amount of cryptocurrency and a huge amount of gold. You'll effectively have hedged against that eventuality happening. Of course, if you want to bet on that happening, then you can bet against gold, and that's something that you can choose to do now. I personally still think that it makes sense to hold gold for all the reasons that Harry Browne outlined as a hedge, and I do still follow the permanent portfolio for my main portfolio. So you'll have to decide for yourself what you think the likely future is going to be with regard to gold versus cryptocurrencies. But I think even if cryptocurrencies come to be significantly more important in the future, there's still an argument for owning gold because it is different to cryptocurrencies. It is a physical asset, and that provides a different kind of security than crypto. It has some downsides, certainly in practical terms, against some cryptocurrencies, but there's only one gold. So even if you're a really cryptocurrency-focused investor, I think you should still consider gold as being something else that it might be worth holding. And as I said, because I follow the permanent portfolio, I actually invest significantly in gold, and I'm still happy and comfortable doing so. I had some other interesting questions from listeners about investing in gold. One question was, what is a good percentage of the total portfolio? And this listener writes, 25%, like Harry Browne argued, seems way too high during non-crises. And I'll combine this with a different question, which is another listener asked, when is a good time to buy? And how long should you wait? So these are very interesting questions. I get asked this a lot about any different asset that you might want to invest in. When should you invest? How do you time that investment best? And combined with that, the other question was how much should you invest in? My suggestion to you is I think you need a strategy. I think you need to work out a rationale for how much to invest in any particular asset. and for when to invest. So I can explain to you my rationale. As I mentioned before, I follow this investment strategy, which is about diversification. The permanent portfolio holds different asset classes, and the idea is you hold different things that will perform well in different circumstances. So with that logic, it doesn't actually matter when you start investing, because we don't know what the future is going to hold. Any one of these diverse assets might do well. It might be that gold is going to do really well next year or really badly next year. But since I don't know, I just hold it as part of a diversified portfolio. And with regard to how much to hold, I know that many people think that 25% is an insanely large amount of a portfolio as a hold in gold. But the rationale for that is simply that the idea behind the permanent portfolio is to hold different asset classes that perform well in different economic circumstances, and we don't know what circumstances are going to happen next. There could be massive inflation next. There's a lot of arguments to say that it's actually really unusual and strange that we've not had higher inflation, given the amount of increases in the money supply that have happened since quantitative easing started. So you could build a really good case to say that the potential for high inflation soon is very, very strong. On the other hand, gold has not performed well in the last few years, and you could argue that it wouldn't have been a good time to get into gold. So I think you need a rationale for yourself. You need to decide what your portfolio is going to be. What different asset classes are you going to invest in, and what percentages are you going to hold? I hold 25% because it makes sense to me to follow the Harry Browne concept of different asset classes held more or less equally to cope with different economic conditions. If you have a different approach, you just need to decide for yourself what that approach is going to be. And if you want to consider different passive investing strategies, a resource that I find very helpful for this that I've mentioned before is the website Portfolio Charts, which has lots of different passive investing portfolios that various people have come up with, and you can choose for yourself among those which one you think makes most sense. Another question I've had is, why wouldn't you own shares in a gold mine as opposed to owning physical gold? And this is a question of strategy again. If you own shares in a gold mine, the idea is that if the value of gold rises, then shares in gold mining companies should rise even higher, because those companies will be, their business is gold. So in a way, this is a way of benefiting even more strongly if the price of gold rises. Harry Browne's suggestion was not to complicate matters by owning shares in gold mining companies, because you don't know whether or not individual particular mining companies are going to fail or are going to be well run and well managed. So you're just introducing more complexity into your investment strategy. And his suggestion was just own physical gold itself, because that's the simplest, cleanest, easiest way to hedge against inflation and economic uncertainty without involving yourself in trying to work out whether a mining company is a well-run one or a badly run one. So that's why I've never been interested in gold mining companies, and I've never invested in them. I just own physical gold and don't worry about trying to get even more of a rise from owning mining shares. So that's my rationale for not owning mining shares, but just owning physical gold. Again, another question that I had was comparing gold and silver investment. Harry Browne wrote quite a lot about this, because many people think that if precious metals are going to rise, then silver should actually rise even more than gold. But the basic idea behind holding gold in the permanent portfolio approach is that gold is a hedge against inflation, and that gold is the asset that is most widely used as a monetary metal. It's the investment that people use as a sort of second reserve currency behind the dollar. Silver is a much smaller market, and it's a bit more specific, and it has some more complicated aspects to that market because it has some industrial uses that are a bit different to gold. So silver is not quite as clearly a monetary metal as gold is, and that's why gold is what Harry Browne suggested. And I follow that approach. That's why I own gold and not silver. So those were some of the questions that I got from listeners. I think I'll just finish by making some suggestions. Again, this is just my opinion. You can decide for yourself whether or not any of this makes sense to you. But I would suggest, if you're interested in owning gold, or if you're interested in following the permanent portfolio and you want to own some gold as part of that portfolio, I would suggest that you start off with a simple service like Bullion Vault, which you can get online. I'll put a link to Bullion Vault in the show notes, which is a referral link, which will give you a small amount of gold for free if you use my referral link. And I think that is a simple and easy way to invest a very small amount of gold just to get you started. So that was in fact how I started investing in gold. About 12 years ago, I bought a small amount of gold on Bullion Vault. And then later, after that, when I decided to invest more heavily, I went to a bank and bought some gold, which was then stored in their vault. And that bank is outside my country of origin. And so that's sort of following the Harry Browne approach. So you can look into that in the future, and the book, The Permanent Portfolio by Craig Rowland, has lots of suggestions about how to do that if you want to go that route. But if you just want to invest a small amount in gold, then Bullion Vault is an easy way to get started. So I hope that was interesting to you. I think there is a lot of, I think the whole question of which asset classes to invest in is a really interesting challenge, and times are changing. Cryptocurrencies are relevant now for investors who are concerned about inflation, and it's going to be very interesting to see how this plays out. But I do think there's still a role for gold in your investment portfolio, especially if you follow something like the permanent portfolio as I do. So I've tried to give you just a general overview of my own experience of following that specific strategy and owning gold as part of that strategy. But I'd love to hear your thoughts too, so let me know what you think. That's all for this week's episode. I'll be back next week with another episode. In the meantime, I hope you have a great week.
Thank you for listening to The Voluntary Life. If you like this podcast, please show your support by becoming a patron of The Voluntary Life on Patreon. Your support will help to grow and improve the show, and you'll get access to a treasure trove of rewards, including bonus episodes. Visit thevoluntarylife.com to learn more.